Today, we're diving into a massive underlying shift that's currently shaking up the entire financial system. Think about it. For the last 15 years, our economy has basically been built on the idea of cheap money. But that era, it's reversing. What we're looking at right now is a situation where the foundational gears of our financial system are starting to grind, and it all revolves around the bond market. So let's jump right into this, because wrapping your head around this dynamic is absolutely crucial for understanding where the broader economy, your personal investments, and the housing market are heading next.
5%. Now, I know that might sound pretty tiny, right? But in the financial world, this number is a massive seismic threshold. For the first time since the great financial crisis back in 2007, U.S. Treasury bond yields have crossed this alarming 5% mark. When a number we haven't seen in over a decade and a half suddenly rears its head again, the whole market pays attention. It's exactly this catalyst that's sending mortgage rates skyrocketing and putting some really serious downward pressure on stocks.
And that brings us to this quote, which I think just brilliantly captures the irony of where we are right now. A world where the safest investments in America become the biggest threat to everything else. U.S. government debt has pretty much always been considered the ultimate financial safe haven, right? Yet, right now, this exact safe investment is the main force causing turbulence everywhere else. So why on earth would the safest place to put your cash suddenly become a threat to corporate growth, real estate, and your stock portfolio? Well, to answer that, we really need to understand the underlying mechanics.
All right, so let's get into Section 1, how bond yields actually work.
At its core, a treasury bond is an incredibly simple concept. Anytime the U.S. government needs to raise cash, it issues these bonds. It's essentially the government saying, hey, lend us your money today, and we'll pay you a fixed, consistent interest rate plus your original investment back at the end of the term. Because the U.S. government is practically guaranteed not to default, this is viewed all over the world as a risk-free rate of return. Pension funds, banks, huge institutions, they buy these up as a perfectly safe place to store their cash. But here's the catch. Lately, the actual prices of these bonds have been completely collapsing.
Okay, let's break down the math here, because this inverse relationship between bond prices and bond yields trips up a lot of people. It's like a financial seesaw. Let's imagine a bond that pays a fixed $5 profit. In a high-demand scenario, if everyone wants that super safe return, investors are going to bid the price of that bond up to, say, $125. Making $5 on a $125 investment means your yield, your actual percentage return, drops down to 4%. But now consider a low-demand scenario. If investors start dumping bonds, the price falls, suddenly someone might only be willing to pay $80 for that exact same bond. Earning that same $5 on an $80 investment, that pushes the yield up to 6.25%. So when you see headlines screaming that yields are spiking, all it really means is that investors are selling off government debt and demanding a much higher percentage return to lend their money.
And here is where that massive ripple effect comes into play. The U.S. government is the absolute safest borrower in the world, right? If the safest borrower out there has to pay a 5% yield just to convince people to lend it cash, well, every other asset in the economy has to adjust downward to compete. Think about it. If you can get a guaranteed risk-free 5% return from the government to do absolutely nothing, you're going to ask yourself, why on earth should I take a risk buying an overpriced stock or investing in real estate or lending to some risky startup unless I'm getting paid way more than 5%? When enough investors start demanding those higher returns, the value of everything else naturally starts to fall. Moving right along to Section 2, 3 forces driving yields up. So why is this happening right now? The sources highlight 3 major macroeconomic forces hitting the market all at once, which makes standard low-yield bonds look pretty terrible. First up, resurgent inflation. Recent data showed the Consumer Price Index jumping 3.8% year over year. Second, we've got spiking oil prices. Conflicts in the Middle East have been disrupting shipping routes, pushing oil past $100 a barrel. And since oil impacts everything from shipping to trucking to manufacturing, higher oil directly translates to higher inflation. Finally, massive government debt. The U.S. is running roughly a $2 trillion annual deficit. That means the Treasury has to constantly flood the market with new bonds just to raise cash. And to make matters worse, this situation is compounded on a global scale. Typically, countries like Japan, who is actually the largest foreign holder of U.S. Treasuries at $1.2 trillion, they buy up a ton of our debt. But right now, Japan's own domestic Treasury yields are hitting historic highs. That gives them way less incentive to buy U.S. debt. So with fewer foreign buyers stepping up to the plate, the U.S. literally has no choice but to hike its yields even higher just to attract investors back to the table. If we look back, history kind of shows us how this pressure builds.
Back in 1994, we had the Great Bond Disaster, where sudden rate hikes from the Fed caused this massive, unexpected market collapse that cost investors over $1 trillion. Fast forward a bit to the 2023 banking crisis, where the 10-year Treasury briefly crossed 5%. That left banks sitting on massive unrealized losses on their older bonds and caused banking stocks to totally plummet. But here's the thing. In those past scenarios, 5% acted like a temporary ceiling. Yields spiked, things broke, but then rates stabilized and eventually dropped. Today, the fear highlighted in the source material is entirely different. What if 5% isn't a ceiling anymore? What if it's the new normal?
Which brings us to Section 3, 4 threats to the economy.
Threat number 1 is what we call the government debt spiral. Now, the US already pays over $1 trillion a year just in interest on the national debt alone. The math here is punishing. Every single 1% increase in yields tacks on tens of billions of dollars to that interest payment. That crowds out other government spending, which widens the deficit, which then forces the government to borrow even more money, pushing interest rates even higher, requiring, yep, you guessed it, even more borrowing. It is a classic doom loop.
Threat number 2 comes right for your investment portfolio. We have to weigh a guaranteed 5% bond yield against the volatile 7% historical average of the stock market. Why risk your hard-earned capital in a choppy stock market for a potential 7% return when the government is willing to hand you 5% totally risk-free? This dynamic is exactly what causes severe sell-offs, especially in high-growth tech companies, because suddenly their future expected earnings just look way less attractive compared to the high, guaranteed returns you can lock in today.
Threat number 3 is one you're definitely feeling if you're looking for a home: a completely frozen housing market. High treasury yields directly translate into higher mortgage rates, pushing them right up toward that 7% mark. And this traps current homeowners. Look, if you bought your house a few years ago and locked in a sweet 3% mortgage, there is no way you're selling that home just to take on a new mortgage at 7%. It would literally more than double your monthly payment for the exact same house. So this keeps housing inventory locked up tight, keeps home prices stubbornly high, and completely freezes out first-time buyers.
And finally, threat 4. This isn't usually some big, dramatic overnight crash. It's a slow, painful constriction. Step 1, borrowing costs rise for corporate America. Step 2, because taking on debt is suddenly so expensive, companies delay their investments and put expansion plans on ice. Step 3, that leads to hiring pauses and compressed earnings. And step 4, the economy slowly grinds to a standstill. Every tiny percentage increase in yields just quietly ticks the odds of a recession upward. All right, let's bring it all home with Section 4, what this means for you. When we dig into the data, a really clear framework emerges between short-term treasuries and long-term stocks. Right now, grabbing a 5% yield in short-term treasuries is actually fantastic for capital preservation. If you're retired or saving for a down payment, or you just want safe liquidity, it's a great tool. But it's super crucial to remember that over a 10 to 20-year horizon, inflation and money printing will absolutely eat away at that 5%. Treasuries preserve your capital. They don't maximize your wealth. For long-term wealth generation, despite the current volatility, stocks have historically offered significantly higher returns, mainly because you are being compensated for taking on that extra risk. So here is your actionable summary on how to handle the end of this free money era. First, stay financially flexible. Second, avoid taking on high leverage or new debt. Just assume interest rates are going to stay higher for longer. Third, be really careful not to lock cash you might need soon into long-term bonds because their prices can be super volatile if yields keep creeping up. And finally, whatever you do, avoid panic selling your existing stock portfolio just because of some short-term fear. Historically speaking, moments of peak panic are very often when the market actually begins to price in a solution. To wrap things up, I want to leave you with this one final provocative thought to chew on. We've spent the last 15 years conditioned to believe that money is cheap, and that whenever rates go up, something eventually breaks and they come crashing right back down. But the bond market is sending us a crystal clear message right now. The era of zero interest rates is pausing, and it might be ending altogether. We have to readjust to a financial system that isn't just running on easy liquidity anymore. So take a look at your own financial strategy and ask yourself, what happens to your investments, your career, and your next major purchase if 5% is the new floor and not just a temporary ceiling? Thanks so much for joining me for this explainer, you guys. Keep learning, stay flexible, and I'll see you next time.